Hi team. In this segment, we are going to explore how the cash flow statement actually balances a financial model. The beautiful thing about accounting and the three-statement model it helps inform is that they create a closed system. What affects the income statement also affects the balance sheet, and any change on the balance sheet must be captured by the cash flow statement. As evidence of these deeply intertwined relationships, look no further than the fact that at this point in the model building process, each line item on the cash flow statement has already been addressed on either the income statement or the balance sheet, and the associated supporting schedules. All of it with the exception of cash. So what is the purpose of the cash flow statement in a financial model? The purpose is to adjust net income by every change on the balance sheet to arrive at cash generated in the period. Let's look at how this works. A few of these line items can be found on both the income statement and the balance sheet, but all of them relate to the balance sheet in one form or another. PP&E, for example, is reduced by the amount of depreciation and increased by the amount of capital expenditures. So everything highlighted green is adjusting net income. We add back non-cash items and changes in working capital to arrive at cash flow from operations. Then subtract any capital expenditures under cash flow from investing activities. And finally, subtract any principal repayment under cash flow from financing activities. The result, cash generated in the period, is added to the previous period's ending cash balance to arrive at the total cash balance for the period, which links back to the balance sheet, and this balances the model. Why? Recall that the balance sheet is just a formal presentation of the fundamental accounting equation. The assets of a company equal its liabilities plus its equity. So the accounting equation is the balance sheet, but stripped of detail. Now, if we look at an expanded version of the accounting equation, you will note that down here, we have the income statement. If the cash flow statement adjusts the left-hand side of the equation, assets, by the company's cash flow in that period, and the income statement adjusts the last part of the right-hand side of the equation, stockholders' equity, by net income, then it follows that the cash flow statement, which starts with net income and ends with cash flow in the period, is making adjustments so that the accounting equation holds true. To make this concept really stick, let's look at how this works using a financial model as a visual. Here you can see the link from the income statement to the balance sheet, where retained earnings grows by the amount of net income in each accounting period. And then the cash flow statement adjusts net income for non-cash items and every change on the balance sheet to arrive at cash generated in the period. And this cash is added to the cash balance on the balance sheet. All right, now here's one last way to think about it that I think can be very helpful. We're going to use the completed model to demonstrate. So tab over to the worksheet 3SM, and we're going to create a zero growth scenario. So input 0 for growth, paste that across, and then we're going to delete everything to the right of the model. And then press Control Spacebar to highlight the last column, and then using the Shift and right arrow key, paste this across for a few years. So this is our zero growth scenario. And quick pause just before we explore this any further, I'm going to freeze this frame so that we can always see the column to the left. And now, in our zero growth scenario, where revenue is flat, all of our working capital accounts should be static. And we can see that in rows containing working capital accounts, including accounts receivable, inventory, accounts payable, etc. Now, we do have one problem with our capitalized financing fee. We can't have a negative value there, so we're going to make a quick change on the debt schedule. And since this is for demonstration purposes only, I'm just going to hard code a 0. And now we don't have to worry about a negative value for the capitalized financing fee row on the balance sheet. Now, the last change we need to make is to the PP&E schedule. In a zero growth scenario, depreciation and capital expenditures should eventually be equal to one another. Think about it. If the company's growing, you're going to be buying equipment ahead of that growth, so capital expenditures will outpace depreciation. But if the company's flat, they should be equal. So we will match these two percentages. And now let's go look at the cash flow statement. With revenue flat and capital expenditures equal to depreciation, you don't really see any changes in value on the balance sheet. which means that the cash flow statement would see net income and cash flow generated in the period as identical numbers. And you'll note that that's exactly what takes place in 2028 when all debt's been paid off. We have net income of approximately $8.5 million and net cash flow of approximately $8.5 million, which should help illustrate that it's the cash flow statement making adjustments based on the activity of the balance sheet, which hopefully really emphasizes that every change on the balance sheet needs to be captured by the cash flow statement. And that is how the accounting equation, and by extension the balance sheet, is balanced in financial models. Mechanically, this is the most important concept to focus on as it relates to projecting the cash flow statement, because there is nothing worse than an unbalanced model. I cannot tell you how many times an unbalanced model kept me in my cubicle residence overnight. Enough times that I created the handbook for analysts screaming at their monitors at 4 a.m., but later renamed it Balancing the Model. I'll provide the link below. In the next video, we will explore some of the differences between cash and earnings, but otherwise, it's all for now. Thanks for watching.